Good everyone, trust you doing good. So I'm here again to continue our section or class on how to spot out inducement and liquidity, how to navigate them in making trade decisions. So yesterday we talked about type 1 inducement, that is inducement that forms after the break of structure. So today we'll be talking about type 2 inducement. These are inducement that forms within before a break of structure. So I want you to pay close attention to spot the difference between a type 1 inducement and a type 2 inducement. So we always make examples using the downtrend and the uptrend. Understand the phase where we are in now is a phase where we are using diagrams. We get to a phase where we are using charts as an examples. So let's dive into the deal of today. So let's say we're having a downtrend. Of the downtrend markets, and we see the market does something like this. First, we want the market to give us a sweep of liquidity, which is market has given us a sweep of liquidity. Then before the break of structure, before the market gives us a break of structure, we want to say something like this. To see if the market gives us something like this. See if the market gives us an inducement like this. The market gives us an inducement like this. So now I want you to pay attention like this now. I want you to pay close attention to this now. This is how the inducement is being formed. I want you to pay close attention to this. So now see this break of structure. This is a break of structure. This is a break of structure here, which is this. It's a break of structure. It's a break of structure, isn't it? So in this break of structure, I want you to look closely. Look at something now. See, let me back my sweep of liquidity first, so I'll be able to explain what I'm explaining. So very easy. So this is my sweep of liquidity. Get sweep liquidity. So now see something now. We have this break of structure here, and where is the origin that causes break of structure? This is supposed to be the original cause break of structure, isn't it? Now I said the origin was if you want to get to our origin, one of the things you'll be looking for is order block which is close to a favor lookup, either order block or a favor lookup. So this should be having an order block or a favor lookup. It should having an order block or a favor lookup gap. That's an imbalance that the price needs to fill before it dish out our full profits. So definitely at this point now we are expecting to see an order block, but now we see the market to give us a little retracement backward. The market did not mitigate this order block, give us a retracement backward, and we are seeing something like this now. Some traders may decide to say, okay, this order block it's far, or maybe it's mitigated. Let me use the order block that is this, and this point becomes an liquidity zone, becomes an inducement zone. The market will definitely sweep many of them out. So I want you to pay attention. When you see a structure like this, never take a trade from this point. Let the market sweep this liquidity, let it sweep this inducement and tap into this order block before you could make decisions of taking a trade. Don't take a trade from somewhere like this, except this point is already mitigated by this. If this point is already mitigated by this, then this should be your new point of interest. But when this point has not been mitigated by this, then you definitely position for this point to enter from this point. But when this point has not been mitigated, this one has not been mitigated, and you're waiting for price to, you want to price to tap from here, and you are entering from a strong, because since this is not mitigated, price will definitely come to fill up this space before dishing out the full profits. So now let me show what I meant. So you have our other block, unmitigated other block, which is at this zone. Yes, we have our other block at this zone, unmitigated. Yes, you have it at this point. At this point, then we have our market do something like this now. Market do something like this, comes our inducements, to a point of inducement, comes a point of inducement. Let me mark my inducement first. My inducement. Okay, so this is our inducement zone. That is my type. What my type? This is my type 2 inducement. Market will definitely usually tap into that zone. When price tap into the zone, you see something like this, price will do as if it's going to move. It's going to move. Then all of a sudden you see a shift. A change in behavior and price, because markets will definitely induce. When it has induced, then next thing you see is the markets shift direction. It's moved to the actual zone. It's moved to the actual intent where the market wants to get to move. It moves from being, it shifts direction, then straight up to ticky, something like this. So we definitely see something like this. We have our buy side liquidity present, which is this zone, our buy side liquidity. Yes, something like this. So see how you see this, how you're going to spot a type 2 inducement. So it's just related. Understand the concept that a type 2 inducement forms before the break of structure is completed, while type 1 inducement forms when a break of structure is completed. Type 2 inducement forms before a break of structure is completed, then while type 1 forms after the break of structure has been completed. So I want you to get the differences. Go over the 2 videos on how that we dropped on. Go over the 2 videos that we dropped on how to spot a type 1 inducement and a type 2 inducement. See what the videos are really saying, what is the differences, what can I learn, and you make that's how you become so good on what you're doing. The concepts are very straightforward, easy. If you could practice, if you could understand the diagram when it comes to the chart, it's an easy thing. So one thing I want to go again. So let's go again. Let's see how it goes. So I said we get our sweep of liquidity, which is this zone. Get our sweep of liquidity, then we wait for price to do its thing. So before we get this break of structure, we already have an origin here. So before the break of structure is completed, we have another origin, which this one, some traders will be marking this point as an internal break of structure. Let me show you what some traders will be doing now. Let me show you what some traders will be doing. Some traders will be marking this point. You see this point? Some traders marking as an internal break of structure, which is not. This is not an internal break of structure. This is an inducement. So when traders are marking this as a break of structure, which this break of structure here is not yet complete. This break of many traders will be marking, oh, we've seen a break of structure, this is a break of structure, so what's an internal break of structure? It's not aligning with the external break of structure. So if you mark this now, this break of structure should align with the external break of structure. So when you're taking decision from this internal break of structure, you know that you are an inducement. So definitely price will definitely clear this internal break of structure, move to the downward, move to the external, move to the actual origin, the actual origin that caused that break of structure. Then it has to tap in. But when it comes to this break of structure too, it's definitely going to respect it, but not fully. It will not respect it to TP. It will respect it, give it a little bit push, induce many buyers that okay, the market is moving my direction, and later sweep them out. So it just it's made for the quick buyers. So if you're a quick buyer, definitely the market will take advantage of you. Or even though you're a quick seller, the market will definitely take advantage of you, because you are placing your trade from an inducement zone. So make sure you do analysis well, and you stay patient and focus, stay put to know what the market is doing. So having explained this using the uptrend market structure, so I'm going to switch using my downtrend structure market, so see how it goes. Also, I like doing this, explain up and down, so when you see the chart, you get familiar with what we're doing, and I hope this will help very well. So now if you're on an downtrend market, so this is how it's going to be. So for downtrend market, this is how it's going to be. So you have something like this. We're going to have something like this. We're going to have something like this. We're going to have something like this. We have our sweep of liquidity. So we're going to have something like this. We'll have price do something like this first. Permits me, I just forgot how to. Okay, so it permits me, please. Permits me, I'm trying to get something done. Yeah, I can figure it out. I was trying to see how to place my sweep of liquidity, so I've forgotten, but I've actually gotten it through. So now, before we have our break of structure, the market is going to do something like this, gives us like this, inducement. So we have our inducement to be present, we have our inducement to be present somewhere like this. The market will definitely induce us. You have to take an early sell, not waiting for the actual price to react from the main origin. So we have something like this. The market gives us something like this. Good. So if the market gives us something like this, we have our break of structure here, downward. Our break of structure here, downward. Our sweep of liquidity, which is this zone, is our sweep of liquidity, making our sweep of liquidity making this point a very protected zone due to this sweep. This sweep makes this point protected. So this sweep now that we have here, this sweep of liquidity makes this point so very protected. Okay, so now I haven't seen our I haven't spotted our our point of interest. That's our order block. Then we'll mark our inducement. And I explained to us that our inducement is just like a point in the market. The inducement is always close to the order block, and it's just like a point in the market where most traders are the impatient one definitely takes trade for. So just because you have just because the market gives you a little bit of, let's say, pushback, doesn't mean the trade is going to move in your favor. Please understand what I'm saying, right? Don't get me wrong. Because the market moves in your favor a little bit based on your little prediction. One thing I want to make you understand is that this little internal break of structure here, it's an inducement. Smart money concept takes it of tells you if you see a break of structure, then you mark your origin of that break of structure. If it's having a fair value gap and on order block, you mark that out, then you position from entry. So that's point. These points it's sometimes an inducement, because what I'm trying to say in essence is that we have our external break of structure, which is this, and we have our unmitigated order block, which is at this point, or our origin, and we have another internal break of structure close to our origin, and our origin is not yet mitigated, and we are having another internal break of structure so very close to it, looking like an inducement zone. So you mark that point as liquidity. That's what you just have to do. Mark that point as liquidity and see what the market definitely does to that point. So definitely the market will push. It will give this, like, it will push, give us a push, like as if it's moving, as like it's a moving trade, like it's moving in our direction, and all of a sudden the market clears that zone and goes and tap into our actual point of interest and dish out full TP. Sometimes your analysis may be wrong because of one or two things too. You may do your analysis and it seems correct, but the market just have to do its things. So not always will your analysis gives you full TP. Sometimes even that's your fine analysis, be it yourself. So be ready to accept the wins and the losses. But one of the goal is that the win should be more than the losses. That's the goal. So I haven't seen this now. So I'll mark my 50% point of interest. Yeah, which is this point. And straight up I'll mark my risk to reward. Yeah, my TP, and my TP. So I'll be risking, actually reasonable. I'll risking this level. I'll just have to risk what I could bear. So if I want to measure this, the risk to reward, I want to make sure the risk to reward is a sell setup. So risk TP, let's say $12, and I'll be risking like $2. This one is to 5 ratio, 1:6 ratio trade. So this how we measure risk to reward, risking like $2 to get $12 and all of those things. So this is how you see make use of this, how you avoid. The main goal is to learn how to avoid inducement, because when you enter this trade, at this point in time, using this internal break of structure, the market tends to induce you by pushing, giving you a little bit of push, you be on profit, then all of a sudden it clears, it goes back to the actual origin, and it clears you out. So I hope you found this video helpful and insightful. If you've been following, please continue to watch, like the videos. If you are seeing it on YouTube, on Telegram, if on YouTube, like the video. On Telegram, you could share to share to interested friends on YouTube. You could like the video, you could say some little comments. It pushes the video viral, it pushes the video to an extent, and brings our labor or our work to many other audience. So I wish you a profitable trading journey. Stay safe and be cool.